My name is Keith Taylor. I'm Chief Investment Officer at One Investment. And today we have representatives from MFS to talk about the fixed income portfolios that they manage for Ontario municipalities. MFS has worked with One Investment for quite literally decades, offering fixed income portfolios for the municipalities that are specifically tailored to the investment needs and the prescribed list. So everything that is offered in these portfolios is built for this audience. So I won't go into too much detail. We've had great depth of history with the folks from MFS, and they're here today to explain more about the portfolios, the positioning, the thought process behind it. And with that, I'll just turn it over to Darren to introduce MFS a bit more and lead the discussion.
Thanks, Keith, and good morning, everyone. My name is Darren Patrick. As Keith mentioned, I'm the head of MFS's institutional relationship management team in Canada, and I'm also responsible for the relationship with One Investment at MFS. And as Keith mentioned, a partnership we're very proud of. We're grateful to be a member of this team with you, and going on 25 years now next October. I'm joined by my investment colleague and co-portfolio manager on your strategy, Somi Kohli, as you can see on the screen today. It's great to be back for this annual webinar again. So thank you for inviting us. Over the next 30 minutes or so, we'll engage with a conversation and not a presentation. So hopefully you'll have some questions for us as we move along. Starting on this page, and I think you've seen this slide before, but I want to emphasize, as we look ahead into 2022, I think it's important just to point out as to how we deliver value to clients, how we deliver value to you through our partnership, and that's through three ways. And the first way is being bottom-up security selectors. We rely on our own views to generate ideas and to ultimately get them in your portfolio. In a few moments, I'll show you a picture of the team that is responsible for this. So we have over 300 investment professionals around the world who are debating and challenging each other with ideas. That's both on the fixed income side and the equity side. That's an important differentiator. And MFS, the way we work is very collaboratively, and every voice at MFS is valued. The second way we deliver on our value to One Investment is through time. And we've got conviction in our ideas, and that's in the middle of this slide. And we believe that we need to let time take its part in order for ideas to come to fruition, to maximize the potential for excess return in your portfolios, or we call that alpha. A good example of this is in your corporate bond portfolio, where over the last 10 years, and in September of this year, we've delivered 38 basis points of excess return over that time frame on an annualized basis. Similarly, in your government bond portfolio, over the same time frame, we've delivered 50 basis points, or 0.5% of excess return per year. Looking at it from a continuity succession planning standpoint, I want to give you a sense of scope of the 300 investment professionals I mentioned. Over 119 of them sit on our global fixed income team, and on average, our career analysts have about 16 years of average experience in the industry and are supported by a deep team of which Somi is a part of. And finally, as we think about risk and your portfolios, an important differentiator is how we look and think and act with respect to risk. And that's by measuring and managing risk from the bottom up. We know how much risk each security is adding to your portfolio. That's important because it allows us to tailor the portfolio when the markets change. I'm going to show a graphic that you have seen before, and it's really an important one. I just want to re-emphasize. We call it our sustainable investing framework, and this is really the important takeaway here is in the middle of this page. Being a fully integrated investment manager for you means that we think about the types of research we do, the data we consume, the governance the structures we have in place, the ways we engage with the companies we own on your behalf, and we do that all across the platform. And that's a really important piece because we don't do environmental and social and governance investing at the side of our desk. It's really a part of who we are as your active manager in fixed income. Somi, as I mentioned before, is a member of our fixed income team. He's in our Toronto office, but that's not where it ends. We have several folks across the equity and the fixed income side of our business in these offices across 8 sector teams, as I mentioned earlier, 300 investment professionals actively debating and challenging and getting ideas in your portfolio or not. And we'll give you some examples of how that works today. A timeline of our partnership is on the next page. Keith, thank you again for the reference of how we've worked with you over time. And as I mentioned, through next October, our 25th anniversary with you, and I've tried to annotate or put on this slide a few of those key milestones in our journey with you together. And I think at the end of the day, what's important to take away here is that everything we've done and every engagement we've had with you, or the way we're thinking about the next thing, is for one benefit only, and that's, as I put on the bottom of the slide, to improve outcomes for municipalities. So having managed fixed income portfolios in MFS for over 50 years, um, we've been through bull and bear markets. We've been through periods of high inflation, of low inflation. We've been through periods of negative interest rates and near zero interest rates as well. And while those things change and while markets evolve, as we've seen over the last 12 or 18 months, our investment process, our investment team, our investment platform hasn't. So before I ask Somi to join, if we want to just advance to the next page, I've done something a little bit different for today, and I want to just set the stage for some of the observations that we've observed that we've made through the end of the third quarter and into the fourth quarter. I've called them key messages. I just want to set the table for today's conversation and perhaps give you some thought as to where, if you have any questions on these points as we go through the presentation. The first is where we're at in the business cycle. Coming through the third quarter, we believe we're solidly in what we call the expansion phase of the business cycle. Well, that's typically characterized by periods of strong economic activity, strong margins, and peak profit growth. And as I look at the economic cycle, we have started to see signs of the economy moderating with respect to going back to pre-pandemic levels. A good example of this is in the US, which was one of the more aggressive countries in providing fiscal support. We've started to see that now come back to pre-pandemic levels, but that's not always the case. For example, in the Eurozone, Japan, they're not expected to be back to levels until sometime in 2022 that we've seen pre-pandemic. Inflation, huge point getting into the third quarter, and of course going into the fourth quarter. We've seen CPI numbers just last month at 4.7%. That was up from 4.4% the month prior. That's the highest increase we've seen since 2003. I don't think anyone on this call is a stranger to the fact that we've seen higher shipping costs, higher travel costs, higher energy costs, also with respect to supply chain disruptions and such. We'll talk a little bit more about how that impacts how we're thinking about fixed income as well. And finally, with respect to fixed income, as Somi will touch on in just a moment, we've seen elevated valuation levels. So we've also seen a long-term structural decline in interest rates and spread volatility that it's obviously had an impact over the last 12 to 18 months as well. So Somi, maybe if I could ask you to join, we could start a conversation on the portfolio.
Good morning, everyone. So first of all, just in terms of the team and things, nothing has changed since the last time we've talked. I really, since we don't have that much time together, what I would like to do is spend the next 15 to 20 minutes talking about the key things that we're looking at and how that translates in terms of how the portfolio is actually positioned. You know, just a reminder, the bond funds we run are high quality bond funds, essentially invested in A-rated corporate bonds or government bonds. So from a quality standpoint, relative to the fixed income market, they're extremely high quality. And there's really two ways that we can outperform the benchmarks that have been set for the funds. One is making a call on the direction of interest rates. So do we think interest rates are going to go up or down? And two, making a call in terms of the level of corporate exposure we are going to have in the portfolio relative to the benchmark, and obviously which specific corporates we'll invest in. So I want to touch on these two themes about what our thinking and what we're looking at in terms of interest rates and in terms of corporate exposure and how that translates into actually how the portfolio is positioned right now. First of all, what you have here on slide 22 is a long-term chart of interest rates. The blue line is the Government of Canada 30-year bond, the yield on the Government of Canada 30-year bond, and the gray line is the Bank of Canada overnight rate. So a couple things just to point out, some are obviously not new to people looking at this in the past. One, the Bank of Canada has not been able to raise rates higher than they were in the previous business cycle. And you can see that the peaks in the gray have continuously been low business cycle after business cycle. I believe that will continue this business cycle. The reason for this lower peaks, in my opinion, is because our economy has become more sensitive to interest rates than in the past, and specifically households. And households, through this pandemic, have become, again, more sensitive to interest rates than in the past because they become through the level of debt. And actually, the Bank of Canada has finally came out with something yesterday saying that we're starting to reach dangerous levels of debt again. Um, that's unlike our U.S. counterparts, I would add, where the U.S. household has actually been in repair for the last decade and not exploding on the level of debt. So it's a long way of saying when the Bank of Canada raises rates, and we believe they will raise rates next year, that they will not be able to get to a level of rates equal to what they did last time. So last time they raised rates to 1.75%, don't believe they'll be able to do it. It'll slow down the economy too much. Next thing, just to also look, is that the 30-year rate and the Bank of Canada final terminal rate, or where they hit that peak, usually end up at the same level. And what this is showing you is that the Government of Canada yield at 2% still may be attractive. And what it's also saying is we believe even long rates will stay low. So a 2% yield on the Government of Canada 30-year bond, if that's where we kind of end up in this business cycle, if not lower, that would not surprise us. And that's kind of our thinking right now. And the reason why we highlight the 30-year rate is because it kind of morphs onto the topic of inflation. Right now, we're in the camp of the inflation is transitory. We will have a higher level of inflation this business cycle than last, most probably. But what we're talking about is it may be on average 0.5% higher or 1% higher. We're not talking about spiraling inflation issues. And the reason why I say that we're in that for this camp right now is it's really hard to get a gauge. When you have bottlenecks in terms of labor or bottlenecks in terms of goods and prices go up, that until those resolve, you don't really know if that will become inflationary long term. We in Canada right now do not have the same wage inflation issues that the US is facing. And I believe partly is that we don't have the constraint on labor the same way the US does. And the reason for that is we still have a very open, active immigration policy. The US doesn't. And so you think about that from a wage standpoint, what that means is if we have more workers coming to work, it's good for your economy, you get more growth, but it also means you don't have a limitation on the supply of labor. And in the US right now, their wage inflation, I believe, has a lot to do with the limitation of supply of labor, as well as some other structural forces, with pandemic relief and other government programs that will eventually subside. So inflation's transitory in our view. Next point on the next slide, Darren mentioned, the business cycle, we're in the expansionary stage, and that's correct. But what's interesting from us on the bond team is, where you are exactly in the business cycle really is important when you're trying to decide the level of corporate risk you want to have in the portfolios. Earlier on, you want to have a lot of risk. Later on, all things that being average, you want to have less risk. And so it's kind of weird in a way to think about talking about where we are in the business cycle when the timeline essentially just started, last year or earlier this year, depending on when you want to actually start the time marks. In other words, when the contraction stopped from the pandemic. Last business cycle was a decade. Business cycles we think historically used to be 5 to 7 years. Now we think maybe they're a little bit more long. It's 7 or 9 years. So we've been in year one. Why aren't we early in the business cycle? Well, because the slowdown was so abrupt, the monetary policy and fiscal policies are so supportive. We've had such a rebound. It is a good point to question where are we in the business cycle? And so what we do is look at actually market-based evidence, not just time. And really the market is implying different things. One, the top left is the level of rates that you get for investing in corporate bonds, the spread on the corporate bonds. One, there are tight levels. And what that means, that typically happens usually at the end of a business cycle, not at the beginning of a business cycle. Residential investment is a percent of GDP. We're using this as a proxy for interest sensitive sectors being invested in the business cycle. I mean, it's still rising. Um, this typically rolls over mid-cycle. I mean, we have a little bit of a downtick on that bottom left, but we'll see if that continues. Top right, monetary policies. Bank of Canada overnight rate at essentially zero, 25 basis points. Early business cycle. That is not saying late, it's not saying mid. And then the unemployment rate rebounding as much as it has, it strongly implies at least mid business cycle. So we know we're not late business cycle. I don't think we're also early business cycle given some of the market indicators. And so we are probably mid cycle. And for that level, what we have to think about, we can be in mid cycle for years. And that will lead us to our corporate allocation discussion, which decisions, which I'll touch base on in a minute. What we have here is corporate spreads in Canada. And what we've highlighted in the gray bars are times when the spreads have risen. Now, the first big rise around 2007, 2008, that's the financial crisis. And on the right side, that peak is the pandemic. But if you notice in between, there's three other little mini cycles that happen. 2011 was the euro debt crisis. 2015 was the energy issues. 2018, I would argue, is that Bank Canada and the Fed rose rates too high, and it caused an issue in the credit market. Most business, if you went to past business cycles, you would not see these three mini credit cycles. Actually, what you would typically see is one. Hence the term mid-cycle correction sometimes you may be familiar with hearing. This phenomenon of these little mini cycles, I think, is a function of the fact that the bond market is more illiquid now than it was in the past. And not the actual bonds itself, but the actual ability to trade bonds. Dealers don't have the same size balance sheet to be able to absorb flows one way or another. We believe this phenomenon will continue. And so the way Josh and I manage your bond funds is as these levels come down and corporate bonds become expensive, we bring down the level of corporate risk. And as these mini cycles lead to these spread increases, we step in and we buy risk. So right now, we are at that lower level, and as a result, we are on the lower level of our corporate range in terms of allocation. And I'll show that to you. And lastly, I'm going to pause there. And I'm going to just go to talk about positioning, and then if we want to talk about the next slide later on, if it comes up questions, we'll address it. So on page 12, what we're looking at here is the positioning in the government bond portfolio. And I really want to highlight two rows. The first row, the option adjusted duration. It says the portfolio has a duration of 2.07 years, and the benchmark has a duration of just under 2.7 years. What that means is, because our duration is below the benchmark, is we are expecting interest rates to rise. And we will generate additional returns relative to the benchmark if that happens. That's one. So we are positioned for rate increases or interest rates to rise. The second thing is the corporate exposure. The benchmark actually has none. Um, and we can go up to as high as 50, and we're sitting around the low 30s. That is the level you'll see us sit at. I would say the high 20s to low 30s, and we were going to sit there for a while waiting for the next expansion in that mini cycle for us to step in and buy risk. Unless we feel like we're coming into the end of the business cycle, then you may see that number go down lower because where you are in the business cycle also has an impact on that level of credit. And we focus us on the top row. What I want to show you is the far right hand column, 1 year change. It says minus 8.9%. What that means is that we've actually brought down our corporate exposure from a year ago by almost 9%. And it was probably a little bit higher even before that, but this chart only goes down, it only goes back for a year. So again, a year ago, spreads were wider. We had more corporates. As they've come in, we've brought them down. And that's this whole idea of kind of getting ready for the next mini cycle as well. So position for rate hikes because we believe the Bank of Canada is going to raise rates, but don't believe they're going to raise them as much as been priced in the market right now. So the range for rate hikes is narrower now than it has been in the past. In the corporate bond portfolio, what you have is, again, we're going to focus on the duration of the bond portfolio is 5.1 years versus the benchmark at 5.7 years. So consistently positioned between the two portfolios about being short duration, expecting rates to rise. The corporate exposure is at 60% versus the benchmark at 48.5. I mean, the 60% is basically the lowest that we can go in this portfolio. So we have brought this down as low as possible in the portfolio, and we're going to sit there and wait again until we can step in and buy risk when it's more favorable. If you look at that far right-hand column, we've brought down the corporate risk exposure down about 7%. And during the pandemic, it was even higher, and we've brought that down. So consistently managed between the two, consistently positioned in the sense of being overweight corporate bonds relative to the benchmark because we still think fundamentals are good, even though corporate bonds look expensive. And we are early to mid business cycle, which generally favors risk assets versus non-risk assets. We are positioned for interest rate hikes. This book is as of September 30th. We've actually had quite a rise in interest rates since the end of this quarter, but we are still short duration position. But if things continue in the market the way they've been lately, like if you looked out 3 or 6 months, it wouldn't be surprising me if we're close to duration neutral, given our view that we think the scope for interest rate hikes are limited. So I'm going to pause it there right now. We've covered kind of the ideas that we're looking for, how we manage it, and now how we're positioned. And I'll see if there's any questions.
Darren and Somi have done a good job of giving you a sort of candid view of the positioning and viewpoint. Obviously, it's nice to have these updates and get a little bit closer to it. But if you do have any questions about the positioning of what they're doing, I'm kind of expecting someone to ask about ESG because that seems to come up in every presentation we do these days. But I'll just start off with a couple of questions of my own, and we'll, if the audience has any specific ones, I can address those too. The talk about interest rates rising. Okay, the question I always get is, I'm not earning a lot of money in my bonds, whether it's through this portfolio or investing through GICs or anything at the moment. People keep talking about interest rates going up, and I know that's bad for bond prices. Help me out here. Is it a good time to be invested in bonds? That's the type of question I get with a lot of investors currently. And it's well-founded, well thought out. But I'd kind of like to hear what your thoughts would be to answer that type of question.
Okay, so um, there's a couple things. First of all, um, so this is going to be general. It can apply to very different scenarios, the question that you're asking me. But one thing I think about in the first case, why would you ever buy bonds regardless of interest rates, right? And historically, the reason why to buy bonds was to offset volatility in risk assets. In other words, if you have a portfolio that consists of some equities and you have some bonds, when the equities did poor, the bonds kind of reduce the pain from the equities. If you didn't care about the pain, in other words, you could live with unlimited volatility, you should be in equities, 100%. They don't, no, but that's the frank. You should be, historically, it would say you should be in equities because you don't care. The issue is with institutions specifically. It doesn't happen as much in our own personal life, but in institutions, pension funds, endowments, municipalities, there's a mark-to-market aspect that um, you know you eventually have to crystallize something, write it down, and sometimes that leads to cash flow impacts or leads to other decisions that get down in place, or sometimes even politically, it's not maybe the best thing to show certain volatility that's happening, even though in the long term it's better. Um, the mark-to-market aspect of it sometimes means even though I like the long-term volatility, I really can't live with it in the short term, that I need to buy bonds. So that's one reason. So to offset volatility and risk, if that's what you want to do, or two, to minimize your exposure to mark-to-market um, ability is the other one. The the reality is your best predictor of your long-term returns in bonds is your starting yield. What you have here on in this slide on the vertical axis is the starting yield of, we just did the universe benchmark, so not your specific benchmark, but the entire Canadian bond market. And what you have on the horizontal axis is the annualized return over the next 5 years. I mean, it's not exactly this, but typically speaking, it is what your starting year yield is almost equal to what your ultimate return will be over the next 5 years. So if your starting yield's 2%, you're going to earn 2%, maybe a little bit more over the next 5 years. And that doesn't matter if your starting yield is 5%, 1%, 3%, that's the kind of case. And that's why you can see that line's going up on an angle because it kind of almost 45 degrees. We further broke that down and said, okay, what about the times when interest rates were rising? And that's the blue lines. And it shows you, even when the blue lines, you may get some years of negative returns, but over the 5-year period of time, you will get a similar type of behavior, that it's equal to your starting yield. And what I will take you back to, if we can go back to slide 20. And so the index, the bond funds are going to have negative returns this year. First of all, what you're showing here is returns of the funds over different periods of time. I want to focus on the middle part of the chart. You can see calendar year returns, 2021 year to date. Look at the benchmark. The benchmark is at 2.4%, minus 2.4%, and then you have the subsequent years. If you started today, like in some ways, I would say, well, you got minus 2.4%, but the year before we got 7.5, the year before we got 5, which was much higher than the yields of the benchmark. So when we say that the starting yield and the end 5-year return will be similar, that's true. The path is not a straight line. We're going to have some positives and some negatives. So even in a rising interest rate environment, over your time horizon of at least 5 years, you should get back your starting yield. And that's important to know even, but you're going to have the negative yields now, which theoretically, if you believe that model in the past represents the future, we should be making it up in future years with some extra returns higher than the coupon in future years. But we'll see. The past doesn't mean the future will happen.
That was a great answer, Tommy. I mean, really, that question comes up with, a lot, and it's very hard to put it in context. And the diversification bit, yeah, that's pretty obvious. But I really do like that last slide you put that showed the starting yields and subsequent returns thereafter. That actually provides a lot of context. Yeah, the next question was related to negative rates. Even though the probability of rates may be low, do you foresee that negative rates possibly happening in Canada for the longer term, like 10-year benchmark, for example? What are your thoughts?
If you asked me this question a decade ago, I would have thought you were absolutely bonkers. And what I would say now is 100% this is possible. The the now so I do not believe the Fed or the Bank of Canada will have negative policy rates. I don't think it's worked, and it's hard to remove once it's in there. So I feel highly confident on that view. Whether the 10-year US or Canada can get negative, sure. I mean, I think what would stop if we had the pandemic rear its head again, and it reared its head with negative consequences, i.e., the vaccines don't work at all and people are dying, there's going to be a flight to quality. And given where the starting yields are, there may be enough demand for those bonds to push them into negative yields. I mean, that's just a question of supply and demand at that point. How many people want it? What countries do they want to go that they feel confident in that they're going to get paid back? And it's not out of the realm of possibilities to see that happen. But I also think for that to happen, it would be an extreme case. It's a tail event, I would say right now, in my opinion.
Great. You mentioned in your presentation that the outlook for Canada is a little bit different than the US. There's different drivers, different circumstances. To what degree do you think that Canada can have like a totally independent interest rate policy and do something different than the US? If the US has to raise rates more aggressively, can Canada can the Bank of Canada sit on their hands? Would there, that may impact, the bond markets directly, but also the currencies. Well, what are your thoughts about the ability of the Bank of Canada to do something different and out of context to what our friends south of the border are doing?
Highly unlikely in the long term. In short terms, you can have slight deviations, which we saw back in 2017. Bank of Canada started raising rates first, and then actually the Fed picked up and went faster and to a higher level. The US and Canadian economy, if I showed you a chart of GDP, I mean, they sit on top of each other. Like you wouldn't know which one is which. They are highly correlated. Our economies are highly correlated. Our demographics are almost identical. The only major difference that has happened in the last 10 years is if you looked at household debt relative to income, I want to say for 50 years. I mean, maybe I know for sure for 30 because I have the chart, but I'm going to even go for longer. Canada and the US was exactly the same. Post financial crisis, we have gone on a debt explosion in Canada, where in the US, either because debt was written off and or they've just, as income has grown, not re-leveraged themselves, we have way more household debt than the US. So that is the major difference, I think, between the two. So one of the issues I think we're going to have is we cannot raise rates in Canada as high as in the US. That's been the case in the past. It's going to be the case again at this point because we are just more sensitive than the US will be. Our issue is going to be is that all rates are global too in nature. At some point, if the US is raising rates to a higher overnight level, it may force things like the 5-year rate in Canada to move, which would impact mortgage rates, for example. So directionally, they have to be similar because our economies are similar. Um, in the short term, who goes first can be different. And in some ways, we kind of get a little bit of a free ride in Canada. If the Bank of Canada can raise rates, but if the Fed hasn't done it, we still kind of get the benefit of the Fed having a lower rate because our economies are so intertwined. But what happens is that once we start raising rates, it really impacts our economy a lot more than it would the US. And so we're limited in scope. So, long answer of saying long term, impossible in my view to have it directionally different. Um, Short term, it can. It can have differences, which can lead to differences in the currency. If you believe the premise that I have that the Bank of Canada can't raise rates higher than they did before, one, and two, we are more sensitive to changes in interest rates, it may imply that, I mean, a lot of it has to do with oil prices too, but just if we just look at those two variables, it may imply that the CAD should weaken a little bit to the US dollar. But historically, right now, we're probably a long-term average, close to average to long-term, long-term values.
Okay, thank you very much. We haven't touched too much on the ESG bit, so just wanted to ask a question or two on that front. I'll note that the because of the legal list, the restrictions on what you can invest in, you're not going down into triple Bs, for example, where there may be more energy exposure and the like, but does that mean that ESG issues are less of a concern for this portfolio, or are they still a concern? And how do you address the concerns that the municipalities might have that their investments reflect their views, and ESG is something, especially E, is something that comes across their desk pretty much every day now, with this being a more prominent concern?
Yeah, I think
Yeah.
I could start off, Somi. I
Okay.
think that's a great question, Keith. Thanks for that. If we want to go back to page 2, and I'll set the stage a little bit more. Um, I think it's a great way to frame it. I mean, it doesn't depend what letter you're on in the E, S, or G. I believe that climate change is one of the most challenging situations we've been faced with in the capital markets in our lifetimes. And so that's something we're certainly thinking about. It's not specific to equities. It is across all of what we do at MFS, how we think. I mean, as we think about credit, as we think about securities we own in fixed income, of course, a lot of that relates to the issuer's ability to repay the principal. So that time frame comes into play a little bit differently. But then again, one of the differences in fixed income as opposed to equities, we have the ability to roll over those securities in shorter increments. And so, in fact, we're going back to issuers engaging with them more often, or at the same time, I should say, as our equity counterparts. So we do have the benefit at MFS as a cross, if I could say this, balance sheet view. And I think that's, whether it's governance with respect to how they're structured, whether it's how they're addressing the environment with respect to the issues they're coming at the market, that's something that we think about holistically at MFS. I know we've got several examples we can speak to, but if maybe we want to draw out an E example for Keith's question, or what have you.
Yeah, I mean, I think so. I want to talk in general our approach, and then maybe specifically within your fund, because you do mention the high quality nature,
Mhm.
and it does eliminate a lot of companies from at least an E standpoint. Um, at the end of the day, when we are looking at making investments on the fixed income side, one of the primary drivers as a fixed income investor is, will there be cash flows to pay us back? Like at the end of the day, we need to get our money back. Right? We're not an equity investor looking at growth. We need to make sure there's cash flows to pay us back. So whether it's an E risk, an S risk, or a G risk, like, do they impact cash flows? And if they do impact cash flows, are we getting compensated enough for that risk? Like any other business risk, really, at the end of the day. And so um, there may be a company that has bad governance, for example, a bad governance structure, but we're getting more than compensated for the risk. And after meeting management, we're comfortable taking on that risk. And even though it may have a poor ESG score, we would keep it. Similarly, there may be companies that have um, good ESG scores, and we may avoid it from an outside rating agency, and we may avoid it because we're not comfortable with um, the rating agency's view. So, I mean, let's talk about one that's been in the press. Rogers. Rating agency has a very strong ESG score on them. I think they kind of missed the boat on it. The governance is kind of blown up. I mean, that's just the reality of it. And that is what it is at the end of the day. And not saying we can miss the boat too. I'm just saying that is one. The one I used to like to cite, and it's not in your portfolio because they are now a triple B security, but some of the grocers have poor ESG scores. And a lot of it has to do with water policies in terms of, within the vegetable sections of the grocery store, lighting, electrical use, and all valid concerns. But do they impact cash flows? And when we sit down and think about it, and you think about when you do your own grocery shopping right now, generally speaking, you go to the grocery store based on location, product, and price. I still to date to hear anyone say, "Oh, they don't use LED bulbs in that grocery store. I am not going grocery shopping there." Like, I'm not saying it's not good for the environment. I'm just saying I don't think it impacts the cash flows of the company. And that's what when we're looking at ESG risk in general, that's what we want to know. So that is an environmental risk. There's no question about it. But we're not, you know, our clients aren't hiring us to impose our moral views. They're hiring us to say, we want you to make the best decisions to make money for their stakeholders. And it is to look at those risks and see if they actually are material from a cash flow standpoint. What I find interesting in your funds in particular, let's take the government fund. Right now, a lot of the ESG risks are related to corporates. But I mean, what happens if there's a province that's energy dependent? Is that okay? I mean, right now the industry says, yep, it's okay. What happens if it's a bank that's lending to these companies, but their actual ESG score is good? Um, right now, the market kind of says that's okay, and so um, it'll be interesting to see because this whole area of ESG is evolving. The tools, the data out there is evolving, and we'll have to see. We'll have to see down the line what happens when you start looking at provinces, um, or municipalities, frankly, that are dependent on those provinces. The market's not there right now, and so the reality is, if you think, for example, your government bond fund, we're basically buying banks and provinces. So there's really not a ESG type concern in terms of the way the market looks at it. But we could be sitting here 5 or 10 years from now and saying, "Do you remember we said we weren't worried about banks or provinces, and maybe investors have changed, the market's moved in a direction where that is more important." And time will tell. It's still very evolving. A lot of the tools and data and where the market's going to settle on this whole topic, I think.
Very good insight. It's the same thing for the municipal sector too. Everyone knows the problem. How they address it and how they frame it is continues to evolve. Just to change things up slightly, Canadian property markets are we'll just say that they're pretty darn strong. They have been for the last year or so. It's a reaction to interest rates. If your view of moderately rising interest rates into the immediate term is to play out, do you think that's going to be enough to bring the property market back into the realm of reality? And most importantly, if we're talking about property, everyone owns a home. What do you think that means for mortgage rates for anyone that actually has to figure out whether they go fixed or floating going forward? So a couple thoughts on that front. What are your thoughts,
Well, I think first of all, mortgage rates will be higher. I mean, they've probably already gone up as the bond market's gone up. So that's one thing. As hikes come in, they'll be higher. I think there were some softening blows from what I understand now that I don't think used to be the case. I guess if you have a variable rate mortgage and rates get reset, instead of changing your payment, you just change your amortization schedule. So from that standpoint, a homeowner is semi-protected in the short term by rate hikes. I mean, it just means they have to pay longer, which is, taking away from money something else, but shouldn't have the same impact they may have had in the past. And I can understand from the bank standpoint, they like that too. They're getting, in a weird way, it kind of insulates everyone from interest rates causing some sort of crash. I would argue that the housing market has not just been good for this year, it's been good for 30 years. And there's a disconnect between housing prices and income. But there's been a disconnect between housing prices and income for a decade. At some point, something has to break. Either it means, and it doesn't mean the market has to crash. Either means one, incomes rise, or two, future price increases won't be as strong as the past. I'm probably more in the latter camp that, let's be serious. Even if we had a 20% crash in the housing market, we're still only probably talking like 2019 prices. It's not we're talking about prices from 2005. I mean, it's still expensive. So at some point in time, it wouldn't surprise me if future returns in the housing market are not as great as the past has been. It doesn't, and that can come just as prices remaining relatively stagnant or going up at a slower rate, or maybe a correction happens at some point. But there is a disconnect, and there is a political issue. I mean, there's an issue of young people trying to buy houses. Frankly, it is, and I don't know what the answer to it is, because whatever the answer is, the current homeowners will not like it, most probably. But there's an issue around there, and housing is it's like a bond. It's interest rate sensitive. So if rates are higher and mortgages are higher, so forget the person going to buy a new house, which actually has to peg that price. Unless you have a tremendous amount of income growth, I think that it will be a little bit of a negative on the housing market. I'm going to be clear. I'm not saying a crash. What I'm saying is it just, future returns may not be as good as the past.
That's great. That adds a lot of context. And that was why I asked the question, the parallel between property prices and bond prices, they're both interest rate sensitive. So slightly higher rates from the outlook that you've given obviously is a negative in the overall scope, but it doesn't mean negative returns. Before they can continue to provide resilient growth. I want to thank everyone for joining and listening in. I hope the information provided by our colleagues at MFS have been useful to help you understand the portfolio, the positioning, the thought process, most importantly. And I want to thank the presenters, Salmi and Darren, for spending the time to share their views with the group. And again, I want to thank you everyone for joining today. And we will have similar webinars like this in the future. I hope that everyone can join again. Thank you very much.